Welcome to Naked Notes, where two chicks talk about notes while they're What? That's not what this podcast is about? Welcome to Naked Notes, where you will learn the honest, unfiltered, and naked truth about buying non-performing notes throughout the country. Whether you're brand new to this type of investing or have your own portfolio, let Naked Notes be your guide through the note world. Now, here are your hosts, Jasmine and Shelby.
Welcome to Naked Notes. I'm your host, Jasmine Wilwa.
Shelby Reed, thank you so much. We are here for Season 8, Episode 6, and we have an awesome show today. I'm really excited to share our guest. We have a guest speaker today, and Jasmine and I are both super excited to share some of the content he's got and some of the knowledge and information that he's going to be able to bring to our audience today.
As you know, we are a fully immersed in notes podcast, right? So it's all about notes. What's special about today is that we have someone who really is involved in the commercial side of things. So commercial notes, yes, they are a thing. If you've ever driven by, especially nowadays, an empty movie theater, a mall, which we have those nowadays. Anything like on a larger scale, there are notes behind it. So what's amazing about today is I really want you guys to kind of pay attention to find out how big this space really is. In the meantime, we want to talk about our note-related moments because we're wrapping up the year here, and I really want people to kind of dig into what they are learning from notes this year. So Shelby, what's your note-related moment?
So my note-related moment this week is to talk about servicing. So we brought on, I think last podcast I talked about, we closed on a new loan last week, which was awesome. And however, it's being serviced by a different servicer than I'm currently using, and we're going to keep it there. And I'm really excited to just kind of try out another servicer. Not saying there's anything wrong with the current servicer, but it's also really great, I think, to have a little perspective and just try another company and organization and see how they do things. So I'm just excited to try them out and see how they work.
What's amazing about what she's saying is that if you're part of the community in Nap Nation, you already know this, right? We talk about liquidity as one of our top 10 rules here, which is 1, be liquid. And when we talk about being liquid, we're not just talking about money, honey. No. We're talking about make sure that you have more than one vendors. When you talk about your vendors and your resources, more than one attorney. So liquid in your attorneys, liquid in your JV partners, someone to back up so you don't have to miss a deal if someone doesn't have the funds available. So always be liquid in your positions when you are investing in notes. So kudos to you on that. Yes, finding services included in that. Always have multiple services for many reasons. Some services are not licensed in all 50 states, right?
Mm-hmm.
Some of then there's always the fees and services that you want to compare. So definitely great point to bring up.
Awesome. Cool. Well, what's yours, Jasmine?
Well, mine is twofold. It's really about kind of the spirit of noting. And it's really because like I said, we're wrapping up the year here, and I'm having some end of the year calls with my Buyers Club members for people who are really trying to dig in with us and just expand their note business. And so a couple things that we highlighted this year is that one thing to take away is grace over greed. If you have grace over greed in this industry, you're really going to prosper. And that is not just coming from the standpoint of how you approach your borrowers. It's really just about the relationships that you have, whether it's through your partnerships, right? And also just when you're negotiating and getting things with new inventory. So I realized that this year, especially even the past 2, as we're coming out of, for those of you who are willing to say, coming out of this pandemic, we've all needed at one point or another a lot more grace over the greed that's been out there normally. So grace over greed is something that I wanted to highlight. And really what that brings me to is the last thing, which is really notes requires sanity. Note investing requires sanity. So that's something me and the last Buyers Club member talked about. And so where does that come from? It really comes from that place, again, grace over greed, but the sanity part comes from you really do have to take some downtime, right? So as we're coming up, for those of you who are wrapping up your businesses, do spend time to bring yourself down a little bit, take time, turn things off the switch, because coming back in January, you have to be able to be very creative, right? And nothing stifles your creativity than you not having a break, not giving yourself a break. So noting successfully requires sanity, and you have to be able to focus on what's important to be successful. And so when you're not calm and you haven't had the time to break, you tend to start focusing on some things that may not be as important. So there are important things, and then there are things that are dire, in my opinion, when note investing comes. So anyway, those are my two note-related moments, which is grace over greed, which circles into the sanity that is required, right? And I believe a little bit of that sanity part comes from you being graceful with others.
Awesome. I love it. Such great information there and such good insight. I think you're exactly right. So, okay, well, are going to take a word from our sponsor and we'll be right back.
Are you ready to build your legacy and work for yourself? NAP, the Note Assistance Program, is here to help you build your empire with mortgage note investing. Receive monthly inventory in your inbox. Get access to top-notch online training and participate in trusted transactions with vetted sellers and buyers. Join their community by visiting noteassistanceprogram.com now and register for one of their nationwide note labs or online training today.
All right, welcome back. Thank you so much. We're joining in today with our guest speaker, Rob Heider. We're super excited he joined us today. Rob is a longtime friend of mine. I introduced him to Jasmine recently, and they, of course, hit it off as I knew they would.
Yes.
But we are just so glad for Rob to be on the show today. He's got some amazing information to share with everyone, and I think he's going to really drop some awesome knowledge nuggets here in the podcast. And so Rob is the owner of Core Properties. He's also the host of his own podcast called Level Up Real Estate Investing Podcast. And I really encourage everyone to go check it out. There's some great knowledge there. They actually just did, really quick, and Rob can probably talk more on it, but they just did a podcast on rolling your 401k into a self-directed IRA, which I think is, I know is something Jasmine always talks about with some of the people she works with as far as investing out of your self-directed IRA. So all right. Well, welcome, Rob. I'll let you kind of introduce yourself and share us a little bit about yourself.
Absolutely. Thanks for having me. I'm excited for this podcast. I love note investing, and I think we'll get some really good stuff out of here. So thanks for having me.
Awesome. Cool. Well, tell us a little bit about you. I know I just kind of gave a little quick intro, but tell us about what you do.
Your background is very impressive. I just wanted to say, so please start there. Highly educated man. So yeah, we always love, hanging out with guys like you. So tell us a little bit about that part.
Yeah, definitely. So my background is commercial real estate finance. So graduated with a degree in real estate and a degree in finance and banking. Into banking right out of college. Worked for one of the top banks in the country, LaSalle Bank out of Chicago. They were bought by Bank of America during the recession. But very high level training, trained by Northwestern's head of their financial program. And it was just like a really in-depth crash course where by the time I'd left Chicago, I lived there for a little over a year before moving back to St. Louis, where I'm at now. But before I left Chicago, I'd underwritten about $1 billion in real estate loans before even kind of getting into actual real estate lending. Been very, very actively involved in all of that. I was in banking for a little under 10 years, solely on the commercial real estate side. For the first half of that career, I was with LaSalle Bank in a very large scale. We averaged $10 to $20 million loans, but it would go all the way up to $100+ million loans. So very, very detailed, just difficult syndications and very difficult kind of deals. Then I went to go work for a local bank, primarily because I wanted to understand how local banks worked and really kind of get a feel for deal sizes that I thought someday that made more sense to me to invest in or kind of get my arms around, right? So I went to go work for
something
a local
you
bank.
can stomach.
Yeah, it just made sense, right? Yeah. So like average deal size was closer to 4 or 5 million. We would do deals up to 10 or 12, but kind of average was there in the 4 or 5 million range. I can make sense of those. $100 million loan, it was difficult to make sense of. Or a project that, was $150 million or whatever. Did that for a little over 5 years. The gentleman that brought me over to that bank became the CEO of the bank within about a year and a half. So I continued to report to him and spent about half of my time working with him directly on kind of board of director level kind of decisions and when banks would divest assets, when they'd sell notes, when they'd foreclose. And I should say, I came over to that smaller bank in 2008. So kind of right before stuff started getting bad. You know, the writing was on the wall, but it hadn't happened yet. And I was too young to even really understand how bad it could get. I go over there in 2008. He becomes the CEO probably, I don't know, mid to late 2009. And I'm reporting to him, and we're kind of going over pretty high level stuff. And a lot of my time was spent on how banks dispose of assets, how they handle the sales of assets. Majority of what we did was commercial. We did have some home builders and residential investors that had big portfolios. So we would kind of sell off tranches of residential properties, but a majority of it was commercial. So did that for a little over 5 years, during which time I started kind of building out core properties, buying rental properties, doing rehabs, dabbling into kind of larger scale construction projects where we would stack second stories on properties or add units to multis and things like that. 2013 went off on my own, and currently we own one of the largest wholesaling companies in St. Louis. Maybe the largest. There's not a good way to track it, but do about 250 wholesale deals a year. Pretty good sized team here in St. Louis that we have. Over 100 residential units that we own. A rental portfolio, just under 200,000 square feet of commercial space that we own and manage. A vast majority of which we bought through note acquisition, and then we also have a division that generates notes, where we'll take real estate, residential real estate, and then we'll essentially sell or finance it to homeowners with 30-year fixed rate loans. And then lastly, we own a real estate brokerage here in St. Louis that mostly on the residential side. We're starting to dabble into the commercial leasing side as well, just to handle some of our own portfolio from that standpoint. So also host of Level Up Real Estate Investing podcast that is ours, and a handful of other little kind of side things that every entrepreneur knows. There's always stuff, always additional stuff on the side.
It's
So,
part of
So
our
now
obligation to give back
Yeah.
and share. It's part of our obligation to give back and share. I got a quick question for you. It seems like you've touched all aspects of real estate, right?
Yeah.
I mean, everything from both the commercial side and the residential side, but everything from like actually touching the physical real estate, you know, renovating, to now the note side. And so my question to you is, how important do you think that is to your success right now, especially on the note side of things? Is it important, do you feel, that made you a better investor by going through all of that?
Yeah, 100%, right? I mean, because you're never really intimidated by a step in the process. Really, when and I'm going to dig into this a lot more, but like when I look at the note side, it's really the same investment. It's just I have additional exit strategies on the front end. So if I look at the underlying collateral as the investment, and then I look at the note purchase plus cost to get to the asset as the purchase price, it's the same, except I have all of the other exit strategies before I actually get to the physical real estate.
Same but more, right? The same but
Yeah,
more.
absolutely. I got more. So I've got less competition on the buy. I've got more exit strategies. I've got easier ways to capitalize it, you know, to recapitalize or turn a profit on it before I even have to get to the actual asset. So there's a
It
hundred
seems like
things.
you've also used it as an acquisition strategy, right? I mean, if you sometimes you, like you say, you have some assets that you keep that you get in from the note side, right?
Absolutely. And we can get to the real estate cheaper, or, you know, because there's less competition looking at the note than there is the actual asset. And
Right.
the bank hasn't foreclosed on the asset yet. You buy the note from the bank, no one's even seen that it's for sale yet. So you're getting to it with less competition, less eyeballs on it, and it's just a better avenue. It's harder though, because if you actually physically wanted the real estate, sometimes you don't get to the real estate, right? They pay you off.
It's
You
not
know,
always
it's
a
not a bad
direct
day.
line.
Yeah, it's not a direct line. You just have to look at it a little bit differently, you know? So it's just an avenue. I think there are a lot of note investors that look at it from a note investing standpoint solely, and maybe some are intimidated about what happens if you have to foreclose and what happens if you get to the asset and all those additional
Right.
steps. I kind of look at it in the inverse, where I'm assuming I get to the asset and comfortable with that. And then if the middle ground happens, then
I'm pretty sure
that's-
that's why we hit it off. Go ahead. Sorry, Shelby.
Yeah, no, that's why I wanted to bring up, and I'm glad you kind of rolled into it naturally. But when Rob and I were first talking about notes, that's my background is also on investing in the actual asset and buying the houses and rehabbing and having the rental property. So to transition into notes was kind of a different mind game. But then, he was like, well, actually, I look at it as every single note I'm buying, I'm analyzing the underlying asset, and I'm looking at it as if I'm going to be taking back that asset. And it just kind of really cleared kind of up some of the muck in my mind to be like, okay, well, that is all that we're talking about, and all of the stuff in between on buying the note, going through any workout strategies or modifications to then the actual underlying asset. I mean, it just dirties the waters a little bit when you're trying to understand it. But when you just think about, I'm understanding the value of this underlying asset and what it is I'm buying, at least for me, it helped kind of it just kind of helped solidify in my mind what it was I was buying.
Yeah, that's why I wanted to bring it up because, there's one thing to have that, textbook education, you're well trained, so was I with Morgan Stanley, and this throughout just hands-on. But that hands-on stuff, I think, is what gives you that confidence. So I wanted to speak to what I'm seeing displayed really has a lot to do with you actually out there getting involved with stuff and the history that you have with the product.
Yeah, definitely. That was it. It made sense. And the crazy thing is, the first big deal that we did was a note purchase. Started kind of prospecting the deal in late 2015 and then ended up getting it under contract in early 2016, right? So what was that, 6 years ago? So it was a 25,000 square foot office building. The note face was 4.3 million. And we got the bank to accept an LOI, so in letter of intent. So it was not bearing yet, but for 2.5 million. And we had 90 days, 30 days of due diligence, 60 days to close on the note, which was pretty good terms. The note, which I should say, a majority of the notes that we go after are non-performing on the commercial side. So note was non-performing, and we were analyzing the asset. We're like, okay, it's a 25,000 foot deal. We're at about $100 a square foot on the underlying real estate. It was 50-something% leased. It's like, right. Okay, at $2.5 million, the existing tenant covered debt service coverage if we were just going to own the asset as a rental, with about 47% of the office space still available to lease. So about 12,000 feet, right? So it's like, okay, that makes sense. Well, while we were converting from the letter of intent stage to the contract stage, the law firm that was drafting up the docs for the bank that was selling it had a client that was interested. And, it's kind of a shady deal, but essentially the law firm shopped it to some of their clients. All of a sudden it became a bidding war, and the price bumped up by about $250,000. So we ended up having to pay 2.73. We fought for 3 or 4 days going back and forth on price and finally won the price. Right. But the terms changed. Mm-hmm. When now I had 30 days of due diligence in 60 days to close, buy term, when we then had to close in, I think we had 2 days of due diligence and had to close in 2 weeks. So 16 days.
Talk about
completely changed.
Yeah, it changed everything, right? So now you're paying more and you have less time. And in that instance, I was very confident I could raise the capital in 30 days. And then even if I didn't entirely, I knew that I could within 90. In this instance, now everything changed and it was crazy.
Like 3 days
the reason
now.
I bring the story up is because the comfort of understanding the underlying real estate and then understanding how to underwrite the note was the only thing that made that deal make sense, because, we had to go hard on $100,000 in earnest money, right. 2 days after, for the due diligence period, 2 days, and then hard on 100,000, and then 14 days to close was difficult. Specifically because,
especially with commercial notes. Yeah,
absolutely. Because, you have commercial leases that you have to understand what the terms are.
I'm gonna dig into that.
Yeah, you have your survey and making sure. In this one, actually, there was an ingress egress easement, which is really just an access easement across another parcel to get to it. So without that, you can't access the asset. It becomes a very, very big issue.
Needless to say,
yeah, and then kind of going through a bunch of the other variables, right? Making sense of it, analyzing the lease, analyzing all of that, and then understanding all the loan documents, all the pieces, and being able to have the ability to think clearly with such a short time frame kind of falls back to what you're talking about.
Yeah, because
Yeah,
it sounds like you kind of did your legwork, you did your research, you did all the due diligence, like you felt confident in what you had, and you knew what you had and what you didn't have. Like you understood that asset and what the pieces went into that asset.
Yeah.
And from afar, it makes sense talking about it. But when you're in it, as every big deal that you're ever in, or even not even a big deal, as any deal that starts getting harder, it's just, as everyone knows, it's harder to see clearly. And it makes sense years later. But when you're in it, it's never as clear as you think, right?
Never.
So that brings me to this. It was an amazing story, and I'm glad you shared it with us because it highlighted, like I said, some of the things that are unique to commercial deals, right? So obviously the most obvious thing is the sizes. So you're talking a couple $1 million. And so that's one of the things I want to bring up. When we're doing individual notes on like maybe a $60,000, $250,000 note, we can turn it around in 5 days and things like that. When they turn your situation to do a commercial note into a 5-day or less type of closing, that's got to get a little bit more sketchy. So one, yes, having a familiarity with the asset, but what are some of the unique things outside of that are unique to commercial deals? Not since we know you have experience with both commercial and residential notes.
So the unique variable is you got to come up with a lot more capital. Analyzing the lease on the underlying tenant, right? You have a residential lease, it is what it is, right? If that lease falls apart, you go and you get a new tenant, it takes you a couple of weeks, not that big of a deal. When you're talking about a 12 or 13,000 square foot office tenant, it's a different story, right? So, understanding what that tenant's going to do, because if that tenant leaves, or if they have the right to leave because the lease was recorded wrong, or there wasn't a subordination, non-disturbance, a terminate agreement, which is called an SNDA, or some other variables, like there are some things that could allow that tenant to get out of the deal if it's foreclosed upon, or if the bank takes over, if the landlord, so there are certain specifics, generally not, but there are some ways that could come up and bite you. But so really understanding the lease and making sure that that's working, because the cost of re-tenanting space is very, very high, right? I mean, especially the higher the class of the office space. And in this instance, this was medical office. So it's very unique to a user. And, you could be talking $75 a square foot to re-tenant that space. It could be $1 million in build out, right?
And big difference between that type of commercial note and a residential note, understanding that if you have to foreclose and you have a residential home, trying to get that ready to sell versus owning a commercial loan, re-tenanting, as you're talking about, is completely different and a lot more money likely involved and just a way more complex process.
Absolutely. You've got lien issues, mechanics lien issues. There were repairs that were being done that weren't completed. In most about mechanics liens, but there are certain instances that they won't. You have variables with that, and then is it totally completed, and do you need that contractor to help complete some of the stuff? So like those are additional liabilities that are going to become yours. That's a big commercial space. Like there's some unique pieces, like HVAC is one, right? I mean, that building has a $250,000 HVAC system on the roof that's very specific for needs of a specific tenant, specifically medical office, right? So, I mean, like, all right, how are you analyzing that? Or are you pricing in the fact that
servicing it and all that stuff, right?
Yeah, and could a portion of it need to be replaced or different things, right? What's the age of it? So just pricing in some of the really big ticket items.
Sounds like you can have a lot more surprises, right? And so with bigger money seems like bigger maybe pitfalls that you can fall into, right? And some more of those. So when you talk about easements, things that get more complicated, more paperwork, it sounds like. And what about the people you're working with? Because it sounds like you're dealing more B2B, whereas we may now come in and have to deal with an actual, just a regular average home citizen, right? So you're dealing with more B2B. Do you find that to be a little bit more challenging or easier when it comes to the trades?
Easier on some regards because everyone kind of knows what they're there to do, right? Harder in some regards because specifically in this instance where you have a set time frame that need to get things done and getting these other business owners to take the time in your time frame is a very difficult thing. So that was a variable that we ran into that instance. Overall, it's you kind of know where you're at with business to business. You take a lot of the emotion out of it. I know we're going to get into it a little bit with some of the moral pieces of dealing with commercial versus residential. So I'm not going to get to that too much, but there are absolutely some pieces associated with that that I think play a pretty specific role. And it's from a financing standpoint. So if you look at it on a residential side, so when we generate notes for seller finance deals, right? We own the real estate, we sell the real estate, and then we provide the loan to the end user, right? Well, we can get back-end financing to finance our position in the loan that we created. That makes sense, right? So if we've got a $100,000 loan that we create, I can get back-end financing for about 80% of that, given the collateral strength is there, right? But when you're buying notes, it's a little bit harder because you don't have all the details. When we generate the note, we know the deed of trust, we know all the ancillary documents, we have,
You created it.
We created it. We have all the underwriting, we have all the stuff. So it's easier to get back in financing. It's a little bit harder in residential if you don't have all of that stuff. And when you're talking about smaller dollar amounts, banks don't really have enough upside to take a stretch. On the commercial side, assuming you know what you're doing, it's easier to get that back-end financing because they can analyze the underlying real estate. There's probably an appraisal that the bank that initially financed did that you're taking the note against. Got very clear, title and a foreclosure policy in addition to the policy that you're assuming as a lender. It's a lot easier to get bank financing. So in reality, on that deal that I was just talking about, we got financing for 80% of the purchase price of the note days. So they funded it. They funded our note purchase. So I only had to go out and find someone to put up about $600,000 in equity. In that instance,
very palatable. Very palatable.
Yeah, it was reasonable, right? And we got bank financing for 2.1 or so, 215, whatever the number was, to do the purchase and got it done. And it was worthwhile for a bank to move that quick. Also, when banks, and this is like little specific BS related to banks, but like if a bank's going to give you a commercial loan, they have to get an appraisal. It's just policy, right? FDIC requires it.
Oh yeah,
but if they're financing the note, same dollar amount, same collateral, they don't have to get an appraisal. So the time frame is much, much faster, right?
Right.
Because they're taking an assignment of an existing deed of trust with an existing loan. So, they can kind of base it off of what was already in place. So little nuances that you can kind of make sense of, but it's not as difficult to get back in financing if you know the right folks and can speak the language that it maybe is on the residential side because the loan amounts are a little bit bigger and it makes sense to bankers. The right bankers.
And it sounds, so I want to circle back on, you were hitting on the moral dilemma, because I think that's something, again, that I didn't really think about until we were having our conversation, a couple weeks ago about the differences between residential note investing and commercial note investing, and that moral dilemma piece, which is when you're buying, we don't have to get too much deep into it, but just the difference there of when you're buying a residential note and it's someone's home versus you're buying someone's office space is a lot different, or you're buying someone's apartment building. It's a different concept there. As an investor, I think it's good to bring that up and think about maybe you prefer one or the other, or maybe you don't care, but I think it's important to take that into consideration.
Yeah, absolutely. I mean, so when you're dealing with commercial note purchasing, the investor that owned that real estate, they knew what they were getting into. They're savvy enough. They're owning commercial real estate. They're getting banked.
They're an investor too.
Yeah. So and like I said, a majority of the time we buy non-performing. So then we come in and we say, hey, we're now the bank. Here's the options, and kind of run through it. And if they choose not to play ball, if they choose to be fraudulent, or maybe they just simply can't play ball in some instances, it is what it is. It's business to business. You know, they knew what they were getting into. We know our position, and then we run with it, with the most strategic avenue. You know, typically with folks work with us, we work with them a lot more, but generally speaking, you know, you've got an agenda that has to be done, a strategy than when you bought that property. So you go through that, right? And at the end of the day, right, you take the asset back, you foreclose on it, you got the asset, okay. If there's a shortfall between what they owed and what the asset was bought for at foreclosure, and there was a guarantee on the loan, well, then typically you can go after the sponsor for the deficiency, right? You'll get a judgment against them because they guaranteed the loan and the loan wasn't paid in full. So you have the ability to go after the sponsor if you choose. That's how it works. That's a very different game because all parties knew what they were getting into. The scenario was what it was. And you work through it, and you know you can sleep at night knowing that you know everyone kind of knew, and it was just part of the deal. The underlying investor didn't meet the terms. You feel good about how you worked with them, and it is what it is. On the residential side, right? You know, if you're buying a note and that note is backed by someone's home and they're living in there, and you know you're looking at it based on numbers on a spreadsheet and how to maximize your profit, but when you're coming in, like they don't really know what they got into typically. I mean, they know it's a loan and if they're not paying, but like now you're talking about foreclosing on it, taking their home, kicking them out of their home. Like it's just a very different ballgame, you know?
Definitely a different flavor for sure.
Absolutely. It's a lot easier for me from a moral standpoint to go at it on a commercial basis. Everyone knew what they were getting into. At least investing in commercial real estate, they're doing their thing versus possibly taking somebody's home, especially if we generate the loans, we know all of the pieces. If we buy the notes, it's just a little bit harder. So that's kind of the more that I deal with.
Yeah, if you're creating that loan, you're involved in the underwriting. I'm sure maybe you're hiring someone to do it, but still, you know all the ins and outs. And so you're really dived in on that, probably that personal situation to an extent.
Yeah, exactly.
What's interesting, what's interesting to me is a couple things. Well, one, 100%, right? When you're dealing on an individual level, a lot of times you do have to hear that person's story to make the right decision, especially when it comes on that residential side, right? At the Note Assistance Program, and with the new fund we are launching, we have the philosophy of make money and go to heaven. So it's possible to make money and treat everybody right, but you have to consider that because otherwise you will and can find yourself in situations. We've heard stories about banks, never mind funds and private sellers who actually have gotten people involved who do not know what's going on. Never mind if they're actually get on the phone and actually are pretending they don't know, but they do not know what's going on. I find that a lot more, especially when I train, in the further you go down what I call the chain in command as far as the paper. So mortgages, I find them to be a little bit more sophisticated and educated, but they go through a lot more pain to educate the borrower, the potential borrower. When you get to those lease up on those contract for deeds and land contracts, a little less educated. And when I find those rent-to-own lease options, some of them are completely oblivious and they will get up and just leave not knowing that they have a contract and may even have equity and value in it. So to your point, it's definitely something, in my opinion, you have to be very conscious about and be able to address that. A lot of the people I know address it by making sure they're the one underwriting the loan so they know. But even then, like you're alluding to, the borrower can only put the best foot forward, right? And then life happens. So yeah, kudos for bringing that up.
Yeah, it's just a little bit different scenario, and you know what was said, you know the terms, you know all the pieces associated with that loan. So you know you can feel a little bit better about it. But it comes down to how everyone kind of thinks through it, right? If the loan goes into default, they're not paying. At some point, the homeowner or whoever the hell it was, like, they know that it can't work for forever. And if it was just a local bank, then or Fannie Mae, Freddie Mac, whatever, they're taking certain steps just like anybody else. So I'm not saying that we wouldn't go that route, and fortunately we haven't had to do it yet on someone's home. We've done it on residential properties, but they've mostly been investment properties, rental properties and whatnot. But so just a difference that's there that I kind of think about as we're digging through these.
Yeah, so it's
Mhm.
100% an option for those of you who are listening to the podcast. You may have never invested in notes. That is something that you have to come to terms with, is that how are you going to take possession of an asset if you are forced to, right? That is literally the exit strategies for most of us, whether you're on the commercial side or not. And we happen to think from that bottom side up, which is, hey, what if we do have to take possession of it? So 100% think about addressing that part of the business before you get into it.
Mhm.
Absolutely. That's key.
So Rob, tell me a little bit about, I know you mostly are investing in these commercial loans and the commercial debt. What is it that is the exciting part for you? Like what is it that makes you want to go after these deals versus buying up some portfolios of the residential debt?
The dollars are bigger, so that makes it a little bit more exciting, right? Generally the sophistication's a little bit higher, and you have a few more exits, you have more understanding of the underlying borrower. Typically, like on the commercial side, you have more understanding on the borrower, because with commercial loans, typically, and I'm not saying like Fannie Mae, Freddie Mac, large insurance companies that give out loans like on a non-recourse basis, but local bank loans, like they typically require updated financials every year. So you have a much better understanding of the underlying sponsor and their ability to possibly refinance that deal. If it doesn't look like they have any ability to refinance it, well, then you have a higher probability. Well, then that's a good exit strategy before you ever get to the asset, right? You buy a $2 million loan at a 20% discount, so $400,000 discount. And then you start putting pressure on the sponsor, the owner, the investor. You start putting pressure on them, and it looks like they do have the ability to refinance. And maybe the bank that had the debt just wasn't good at putting the right pressure on the folks, which happens all the time. Well, then you get a refi, and about 90 days, and you can turn a pretty good pop very quickly by doing so. So there's just different avenues, right? So you have more access. Also, if there's a commercial tenant in the property, not like mom and pop 2,000 square foot kind of space, but a reasonable sized commercial tenant, well, you also generally have financials on the tenant, and the leases are longer term, and they're established businesses that are in there that want to stay. Well, more times than not, if the sponsor was having trouble with the debt and maybe was not performing because it was a non-performing loan, well, there's also a good chance that the real estate's mismanaged. And we find that a majority of the time. They're not billing back for reimbursements properly. They haven't measured the square footage properly to take into account, their proportionate share of common area. They haven't bumped rents. We bought we had a note under contract on a almost 16,000 square foot office complex in St. Louis. We're actually getting to closing on the note purchase. We ended up converting it to a structured short sale because title was clean and there wasn't really any reason not to. We end up doing that. We get into the asset and we reach out to all the tenants and tell them that the rent's going up by 30 something %. And they were like, nah, we assumed it was going to happen someday. Like they knew that it was wrong, and they were just going along with the easy step.
But the cool thing is they've got the ability to, when you went to them and said, okay, we're bumping your rents up, whether they were a larger business or established business, they were like, okay, I can pay that. Fine.
Yeah, they knew it was under market for a super long time. Wow, you go and you bump someone's rent 30%, like
get ready for the squirreling.
Yeah, but they're home. Like that's just a harder thing to get. Like you got to kind of baby step into that sometimes, So that's pretty well it. You got more information on the front end on what your exit strategies are going to be based on financial strength of the borrower and kind of the basis, a little more data, and then also you have a little more data on the specific property typically. Hey, one thing I forgot to mention: a big variable on commercial. You said when you asked about differences earlier. Assuming we're not talking about multifamily, assuming we're talking about retail, office, industrial, self-storage, in all the gamut, right? Environmental studies is a big variable. That's a huge difference that folks don't.
Environmental studies, you said?
Yeah. right? Because if you buy an asset, you buy the note and then you take over the asset and it has environmental issue,
Those are your problems now.
yeah, then it's your problem. So, I mean, there are lots and lots of stories.
What
of
are
financial
some
companies.
examples? Like, what do you mean? Like environment, like soil issues or air quality?
Yeah, soil
What do you?
issues. Yeah,
Okay.
so you mean you could be downgrade from a gas station that had a leak, and now your soil is contaminated and has to be cleaned. Groundwater issues, contaminated groundwater. You could have a new one that just came out that is new to all environmental issues is vapor, right? So like
Mm,
you can have a gas station that's 6 parcels over that leaked 60 years ago, and they do a study, and
Right.
the sprawling of the oil hasn't gotten to your property, but oil always sprawls, right? Because soil is compressed, it's denser as you go down deeper, right? So the oil isn't being absorbed, it sprawls. Okay, well, typically when you have those kind of things, you can get what's called a no further action letter from the state that you're in, assuming it had been cleaned up properly and dealt with properly, or your environmental report was good. But what just happened in the last 5 years is now they've included vapor in addition to soil contamination, groundwater contamination, missing one other one. There's 3, and then now it's vapor. Where if there was contamination, well, now that vapor of that oil can now penetrate into your commercial space, and now you're liable to remediate it, or you can be sued because people could be getting sick because they're breathing, air that's contaminated
the
with
vapor,
different vapors.
yeah.
So it's
That's
a really interesting new
interesting.
piece, and even a no further action letter from 5 years ago would have mitigated the risk of the first 3, but now there's this new one that's not included in the no further action letter that wasn't even being monitored before. So there's just new pieces.
It's deep.
Typically,
It's
what you
deep.
do, what's that?
I said it gets deep. All puns intended. It gets deep.
Yeah, super deep, deep, and
I thought you said it gets deep.
Deep.
Kind of branching off that a little bit, what are you looking for when you're looking for commercial notes and debt to buy? What specifically are attributes that you'll see on a loan and it will pull you in and be interesting to you?
Yeah, I mean, so obviously a larger discount against face, right? Like,
Mhm.
So
So a little more
bigger
distressed,
yeah,
potentially.
yes, exactly. So the bigger discount against face is the basic one, right?
Mhm.
Because that just makes it easier, assuming that the collateral is strong enough to cover the loan. So it's like in that instance that we bought that one for 2.75 essentially, and face of the loan was 4.3 million. I thought the collateral was worth 3.5 at the time, but it was getting kind of tricky. It could have went up to 4, but it was just there were some unknowns.
Mhm.
But so, all right, so you kind of make sense that you're like, okay, well, yeah, the discount was great, but if the collateral didn't meet the face, then the discount didn't matter as much. So
Right. The collateral is almost the second step of that, right? Because you got to understand the discount to the face and then understanding the value of the collateral.
exactly, yeah. So you say, okay, well, collateral to face would be one way to look at it, and then discount against both of those. So that's
Mhm.
step one. So that's the easiest way, sexiest way to look at it.
Mhm.
Because then if you get paid off, right? You get paid off, then you make
There's your
that.
pop.
Yeah. So you always have to assume that's an avenue. Or you don't get paid off, but you take it to foreclosure, and then someone buys it, and you're not the one that gets it, right? Well, if it sells, and it sells for more than face, well, then that amount goes back to the borrower. You don't get it as the bank.
Right. So you only get what's owed to you. The legal balance is what it's called. And so
Yes.
that's the important part that you guys, when we do our exit strategy, we talk about budgets. That's one of the things that we always consider is like what could happen in that scenario, especially when it comes to the residential side. We have to go in most of these states, we have to go to the sheriff's auction. We have to go to a sale. There are certain ways that we know how to get around that. And a lot of those efforts are we're at the mercy of the judges and things like that, but we do have ways to try to get around the sale itself. But yeah, true to that, and that holds true to us, the residential side, because they want to make sure that banks are not really just incentivized for that greed, right? So get what's owed to you. And that for us, as we buy them in the secondary and tertiary market, that's going back to him talking about how important that face value is how important that is. We just looked at a new tape right now, and the broker involved marked it all the way up that he wants over the full payoff. So that's over what's the legal imbalance is. And what you do is you cut off some of your legs. I mean, you cut off some of your strategies right there. Can you make money off of that? I'm sure you can. And you got to figure it out, but it definitely makes life a little bit more difficult.
Yeah, I mean, if you're getting overfaced, then you got to assume that you're going to be getting that rate of return. It's a good, strong rate of return for an extended period of time. Maybe they have really strong prepayment penalties and some things like that, or that you're going to get to the underlying collateral and it's a very low loan to value against the collateral, and there's high probability you get to the underlying collateral, right? So that's kind of the piece. So you kind of have two steps, and that's the answer back to your question, Shelby. You've got the front end where it's a disc. If you assume that the collateral is equal to or greater than the face of the loan, right?
Right.
Okay, let's just assume that for now. Okay, well then
Right.
a greater discount against the face of the loan is ideal, of course, right? You have all the
Correct.
extra strategies then. And if you foreclose and it sells for face, you still make your spread. It's all good. There's instances that we go after a lot, specifically because there's a lot less competition on these and they're abundant, but is you buy it very close to face. And Jasmine kind of touched on this. I mean, going above face, it's really tricky. It's kind of a gamble. You got to do a lot of them because sooner or later, like you can get bit on some of them, right?
Yeah.
But if you buy at face or within a few percent of face, well, then you have to assume, okay, well, either the rate of return is so good that it makes sense, or the underlying collateral is strong enough, and then you can actually get to it. So, and we do that
For sure.
where it's like, okay, well, face of this loan's $2 million. All right, we'll buy it for $1,950,000. So 50,000 then covers any of our legal expense on the front end, and whatever. If it does just
in case they pay it off, they refi right away.
You can bill a reasonable amount of your time and whoever you've got involved against it, so it's not a direct loss. So it's like, but why do that? Well, we'll do that if a loan is already in default and the likelihood of them curing in the near future isn't that high. And maybe base interest rate was 6%, but the default rate's 15%, and they can't refi it, but they can make the payments. Maybe those tenants in place that the asset can more than cover the 15% interest. Well, all right, cool. I don't need that big of a discount because I was going to make a 15% income stream for an extended period of time, right?
Right.
Yeah. Here's what I want to tell you for those who are listening to us, especially as we wrap this up. One of the 30,000 foot view things is that the devil's in the details. The terms seem to be so important, especially when you're dealing with the commercial, right? So hands down, I always jokingly tell people, if you're not into reading, if that's not your strength, you don't like to do that on your pastime, then note investing is going to be a difficult sport for you. Because again, no matter how big the kill is, no matter how big the deal is, or the returns are, you really aren't going to know what you're getting until you dig into the terms of each individual contract. And each seller has different terms, right? So some may have similar terms per contract that they do because that's how they work in-house, but guaranteed donuts to dollars. If you're out there buying from different sellers, you're getting different contracts each time. Wouldn't you say so?
Absolutely. Yeah, everything's different. All the variables, yes. Even like the standard loan docs for local banks. It's like most local banks that do loans probably, I don't know, sub 5 to 10 million. There's 2 or 3 standard loan document softwares. One of the most popular ones is called Laser Pro that almost all local banks use, right? But even within those docs, there's so many nuances and additional variables that banks put in and have the ability to put in and change up. So, and then the sneaky part is anytime there's an amendment to the loan or a modification, and make sure you have all of those, because all of the terms of everything you read could be totally wiped by an amendment that is out there. That change the terms or modification, right? Just kind of reading there. I mean, when I read the docs, I typically start at the back. I'll read amendment 8 and 7 and 6 and 5 and 4.
Start
loan docs because
because
it doesn't make a ton of sense to read the original if you've got 8 amendments.
Yeah. I kind of find myself doing that too. When I pull title and I get all the title, I scroll to the very bottom, and just so I can kind of have some context when I'm scrolling back up to be like, okay, like put in my mind, like I've got like 3 or 4 renewals that I've got to get to too. So I don't pay too much attention to what the details are until I get down to those bottom docs.
Yes, ma'am.
Yeah.
Yeah.
So
Okay, really quick before we wrap up though, I want to go back to that last thing. I want to finalize that story where you're talking about buying assets close to par basically. The way to do that is, one, if you feel really confident about the rate of return because you know your yield's going to be high and you're happy and you'll just take that, you know, that return.
mhm.
Or the other, and I'm asking you guys if this is the answer, is the other way to do that is because you feel really strong about the collateral value being higher than what the loan value is, and that you feel it's distressed enough, or that you feel like there's some way that you're going to be able to take that asset back. Is that correct?
Yes.
Okay.
So
I just wanted to complete that circle.
So if they can't refinance it, the likelihood of them securing it at foreclosure is going to be slim to none.
Mhm.
Jasmine mentioned some outside strategies. Like typically what we would try to do is come up with an that if we were getting close to foreclosure, we try and do like a deed in lieu of foreclosure. And then
Mhm.
an out, or we won't go after them personally for the guarantee. Well, then that allows us to get to the asset without having to foreclose, because we go to foreclosure, then we risk someone bidding it up above that amount, and then limiting our margin, right?
And
So-
what happens then in that situation? So you guys talked about this and I didn't get to ask. So what happens if it gets bid up above what your debt amount is? You're going to get, as a lender, you're getting paid your debt amount. And then who gets, the borrower gets the difference?
Yeah. So, Jasmine mentioned legal balance. So that's like legal balance is really the face of the debt plus all fees, past due interest,
Yes.
legal
Late fees.
expense,
Mhm.
publication. So like that's that dollar amount, right? So
Mhm.
let's say face of the loan's 2 million, maybe after all the fees, all the stuff, legal, maybe it's 2,050,000. Cool. So you go to foreclosure now, someone bids 2.5 million because the collateral's super strong. Well, you get your 2,050,000, but then that difference, that 450 grand, then goes to the borrower.
Yeah. Okay, that makes sense. Which likely probably goes to pay off their debts at some point, because obviously they're in foreclosure for a reason. So I'm not going to make the assumption they're just pocketing it all, but still, that's a good thing to point out.
Well, it paid off the debt on this property, any other problems they have. Yeah.
Yeah.
But from a strategic standpoint on getting to the collateral is being the most strategic as possible to avoid that scenario. Right.
Mhm.
You have to be above board. You can't,
Sure.
you can't
Mhm.
interfere with foreclosure process, any of that stuff, but deed in lieu foreclosure is an avenue to access, in some instances, so on and so forth. There's other
Mhm.
strategies associated with that.
For sure. This has been amazing.
I know. So what, really quick, last question, and then we'll stop. But I feel like we could talk for a lot longer. What does 2023 look for you with your investing strategy and notes? What are you excited about for this coming year? Or what are you, one of your goals, or just a quick synopsis of what you're looking forward to and excited about this next year, and what you're going to go after?
Yeah, absolutely. I think note buying is gonna be great in 2023. I think, you have a ton of unique scenarios all kind of coming together for a perfect storm to some degree. So you have poor business operators.
Rob is really quick. Rob is really good at the economics. So I'm so glad you're hitting on this, because it's really highlighting such a skill set you have. So keep going. But Rob is so good at the economics. So everyone needs to listen, because I feel like you're probably spot on.
Well, awesome. Hopefully I am.
Most of the time you are.
Well, thank you, Shelby. No, so I think, you have perfect storm of a lot of weird things going on. So you had poor operators that were likely having trouble pre-COVID, and independent of being a poor operator or having issues or not operating correctly, you got bailed out as a result of COVID. You probably got both rounds of PPP. You got some big EIDL loan that's a 30-year term at 3.75 interest rate, right? So like you had a bunch of bailout, there were outside grants, all kinds of things for folks that were harmed by COVID, independent of whether they truly were and things were going well before or not, right? So if they were poor operators beforehand, well, a lot of that bailout money that helped them get through has burned off. And I'm hearing this a lot from bankers, where it's like, Also,
Mhm.
banks weren't getting pressured by the FDIC and their state divisions of commerce, state divisions of finance to really put pressure on a lot of these borrowers. In many instances, they would defer their interest and principal payments and then tack them onto the backside of the loan, which was okay in some instances because a lot of times the collateral values escalated enough to make that make sense, right?
Mhm.
But nevertheless, you have all of those scenarios coming to a head. Also, you have more and more loans that are coming to a maturity, especially with commercial loans that are typically 3 to 5 years in term. Well, it's not like, if it was a 5-year term, well, that means that they would have financed it in 18. Okay, well, that seems reasonable because banks weren't like, oh yeah, we'll refi this when you can't show income and all of your income is based on bailouts. They're not refinancing that in 2020, 2021, 2022. They want to understand where they're at, right? Well, now those same deals, as they come to maturity, are coming to maturity at 1.5 or 2 times the interest rate that they were before. So things are about to get a lot harder. So the likelihood of getting refinanced is much less likely. So, okay, if you were a poor operator before and you were banking on bailouts to get you through, those bailouts burned off, and now you have to be a good operator. Well, if you weren't one before, the likelihood of you being one now is probably not very high. In addition to that, you have to be a good enough operator that if your deal wasn't working at a 3.5 or 4% interest rate, that it now has to be 7 or 7.5% interest rate.
Probably not going to.
Yeah. Also, if it's on a commercial basis, they would have had to have enough capital to pay, with tenant roll, they would have had to have enough capital to pay for capital improvements, costs, things of that nature. At the same point, all of those construction costs and capital improvement costs have all gone up by 1.5 or 2 times as well, So just pulling more funds away from deals, making them further and further into distress. So I think that there's a lot of variables coming together to make it a bit of a perfect storm on the note buying side.
Yeah, I was going to add. We've got a lot tighter money supply, and this inflation also that's hitting these borrowers upside their heads, and from the commercial side as well. Then you've got the interest rates that if you were able to get at what you said a 3 point or 2.5 before, that's not happening nowadays, right? So a lot of these other things from the economic side are also playing into what I expect to be a pretty good 2023 as well. Because a lot of people are not going to have those options. So where do they go? They have to come to us for the creative side, or we're going to assume them and work them out and get them at discounts. So it's good stuff.
100%. And it's a great time for generating mortgages. Residential side, many of the, most of the time they're 30-year fixed rate loans. Maybe they were 7-year ARMs, but 5 and 7-year ARMs weren't really leaned into too heavily over the last window in time, just because rates have been low enough that there wasn't much of a price gap to make that make sense. And they were so kind of frowned upon coming out of the recession. But, you have defaults and you have folks that are struggling. And as soon as defaults trigger, then they hit default interest and they're not going back down to that 3.5% on the residential side as much. So now they have to figure out how to make it work. So
and those default rates are pretty handsome. So definitely, yeah. Love it. Well, thanks for coming by and sharing your wealth of wisdom. It's been amazing hanging out with you.
Absolutely. And I appreciate it. Thanks for having me on.
Yeah, one of the things we always like to ask people before they leave is what ways can our listeners work with you? So as we head out of here, can you please give us your contact information and just a brief idea of going to 2023, how we can get involved with you if that's even an option?
Yeah, definitely. No, going into 2023, if folks are looking at, residential notes, you can certainly help them with those and folks can kind of dig through the weeds and figure those out. On the commercial side, many times folks are good at going out and talking to banks or talking to people they know and kind of drumming up those deals, but getting through the specifics and understanding them and like really understanding what they're looking at and whether it's a good deal or not, and then raising capital to get those, that becomes a sticking point. So we can absolutely help with that. We partner with folks that are doing commercial notes, so we can help on that front. And then also, they can check out our podcast. We dig deep into the note investing side on that front as well as some of the more of the kind of commercial investing aspects. Folks that want to get involved in that regard, just kind of learning some more on some of those variables.
Any type of syndications for people who may have money to invest with you? Are you just kind of private funds on the outside and looking
Mostly
at
private funds. So we've talked about it, and we started building out a fund in 2020, thinking it was going to be prime ground to buy notes. All the reasons I said earlier were the reasons why it wasn't a good time, but all of those same notes that would have been sold, I think, will be coming up in the next couple of years.
they always come back.
Sure.
Yeah.
Mhm.
So with
Sure.
with the FDIC not pressing and bailout money, there's no reason to sell. But instead, check out all my social media handles.
Yeah, I just saw you online. You have a great website, and totally encourage you guys to check them out. And most importantly, if you're out there and you see a deal, bring it to him and see if you guys can get something done. What regions are you working in as we exit here? Because it's not nationwide. Like, where's your sweet spot?
Yeah, primarily the Midwest, right? So Missouri, Indiana, Ohio, Tennessee, and then down into Florida and into Texas. So those are kind of our main ranges.
Quite the following down there. So if you guys are listening and you're in that area, this could be a time. Let him know that the Naked Notes lady sent you, and I'm sure he'll try his best to get the deal done. We appreciate you so much.
Awesome. Thank you, Rob.
Absolutely. Thank you, Shelby. Thank you, Jasmine. Appreciate it, guys.
All right, check us out. That's a wrap, you guys. Check us out on nakednotespodcast.com. Check out our Facebook as well, and YouTube for our video. And we'll see y'all next time.
Awesome. Thank you so much.
Thank you for joining Naked Notes. Jasmine and Shelby are not attorneys, and this podcast is intended for educational purposes only. For more information about how to work with the Note Assistance Program, please go to www.noteassistanceprogram.com to get details of the programs they offer to help you get started in notes. You can also find them on Facebook at Note Assistance Program. Be sure to also check out their meetup.com page for monthly lunch and learns, note labs, and other events. Make sure to check back regularly for new episodes, and let Naked Notes be your trusted partner on your note journey.